Willie Delwiche is joining. He's a Barrett investment strategist. Willie, you've got some numbers and analysis looking through sectors. I mean, what are we finding? Is there anything that shines in this market, or are we at that part of the sell-off where breadth just kind of piles onto the downside?
Well, so far that's what we're seeing. We're seeing bad breath begetting more bad breath, and we had less than 10 stocks in the S&P 500 up yesterday. It was pretty much very broad selling across the board. Eventually, we can start to look for relative leaders and things that are showing some encouraging signs. But at this point, it's very broad selling that continues to have momentum to the downside. This morning's strength notwithstanding.
So when we look at the breadth breakdown, there's always this question of, is it just beginning or is it capitulation? Is it the part of the trade where people are panicking? What does it look like to you?
Yeah, so from a longer term perspective, and you're showing our weekly industry group trend chart, it looks like we're beginning to break down, not that we're at the end of a breakdown. Part of that is the speed with which we've fallen apart. We were, 13 days ago, we were at all-time highs. So we're still seeing evidence of weekly trends starting to deteriorate. On a daily basis, we continue to see way more downside volume than upside volume. That's evidence of downside momentum. And so while people want to be hopeful and encouraging to say, okay, we've reached capitulation, we've gotten sold out, we're not going to know that until after the fact. And what I mean by that is we're going to have to see strong upside momentum start to come in. And so, thinking about today, does today's rally have legs? We'll know that if upside volume overwhelms downside volume by better than 9-1. Until then, it makes sense to stay cautious and stay patient and let the downside momentum run its course.
So by this chart, basically the breakdown in breadth that we're seeing on a sector basis still is not quite as brutal as we've gotten in other recent sell-offs. Am I reading that right here, 2016 or the end of 18?
Yeah, that's exactly right, and that's the discouraging part of the price move that we've seen already, is that from a weekly perspective, it's just begun. Part of that is that there's some trending that is in this data, and so it'll take some time to catch up. But this move we're seeing is coming off of a relatively strong breadth backdrop, and so that suggests there is more work that needs to be done to the downside at this point, or we need to see strong evidence that it has run its course. It's not at a point where you can say, okay, long term we're getting to oversold levels. So it's too early to say for sure that we're oversold. That doesn't preclude a rally, but I would say let's wait for the evidence to be there before assuming that it will emerge. And
how do you guys calculate this sector breadth indicator?
Yeah, so it's a very big spreadsheet. It looks at the trends for the industry groups in the S&P 500, S&P 400, S&P 600. So we're looking at industry groups across size capitalizations and getting a sense of whether the 10-week trend, 40-week trend, where they are relative to each other. Trying to get a sense beyond just the day-to-day fluctuations and get a sense across the board of what the breadth trends look like.
Right now, we have an added complication on top of a market that was already worried about COVID-19. Of course, it's the price war between the Saudis and Russia on oil. But overall, it seems like it is still this viral outbreak that is at the core of our weakness. One, do you agree? Two, does that mean that we should expect this market to get better if the virus spread slows down? What do you think? Is that relationship going to hold? Is it going to work on the upside? It's been working on the downside. More viral cases, lower stocks go.
Yeah, I think it certainly started as catching up to the viral outbreak. There's an element to what we're seeing in the market right now that has been maybe years in the making and is kind of internal to itself. And so would it help to have some answer to the virus? Yes. But I don't know that alone is sufficient at this point. I think we need to see evidence of real meaningful pessimism build. We need to see evidence that stocks are actually washed out. And then at that point, then maybe slightly better news on the virus, or like you were mentioning before, continued strength in the economy. Then that can provide a tailwind as we go through 2020. But I think we're still early in this process, and that patience, I think, is really important right now.
When we see the sector breakdown, obviously there's some stuff that's been working better. Staples, we've seen consumer staples in places like Walmart do all right. Costco's been hanging in there. Of course, Clorox has been there as well. So that one stands out just observationally. What else do you see? The bank breakdown, which sectors here? Is there a preference by the market to sell and buy some in particular, even within the carnage, if we go like second degree?
Yeah. Oh, for sure. Where are we seeing particular weakness? The two obvious ones are financials and energy. They're leading to the downside clearly. Industrials are making new relative price lows, so that's something to watch there. Areas of strength, utilities and real estate, they tend to get a bid when yields move lower, so that's not too surprising. What I did actually find interesting doing the weekly sector look this week is consumer discretionary and healthcare are holding up on a relative basis, and then also on an absolute basis when you look at sector level breadth. So there's some signs there beneath the surface that it isn't just everything's going down. Things are going down to different degrees, but discretionary and healthcare might be areas to look at for leadership once we come out of this environment.
We're looking at another chart I want to get your take on before I let you go, Willie, which is your three-factor sector model. What exactly is this? Because this one does look like it is getting back to some low points of pain.
Sure. So the three factors, it's price, momentum, and breadth at the sector level. So it's not just price for the index, but price for each of the sectors, where it is relative to short-term trend. Same thing for momentum, same thing for breadth. And yeah, it's getting pretty sold out. The key here is any rally that's going to be sustainable, we want to see this get back into positive territory. Rallies that end with our sector breadth model, or sector model here, still in negative territory. You go back to the fourth quarter of 2018, we had some rallies, but they didn't go anywhere. The model didn't get back into positive territory. Once the lows are in place, once we have some confidence that a rally is resuming, we should see evidence of that by sector trends turning positive, and hopefully that happens at some point within the next few months. But we'll have to watch and see. Okay,
Willie, really great setup here for us today as we continue to watch a market that is breaking down, but with some preference here for some groups over others. We've seen a little bit of outperformance. Willie Delwiche, Baird investment strategist, great charts and analysis as always.